everybody, this is Coach D here with TackleTrading.com. If you attended this week's Coach's Show, you remember that we did the rapid fire segment and that the winners of the rapid fire segment will be able to submit their questions to me for a video response. And we had one of the candidates that was put forth during the rapid fire was ticker symbol PLNT and Planet Fitness. It was a great looking chart. And that was submitted by Daniel Mack. And Daniel sent me his email question, which I have up here for you. And I just want to cut to the chase on that, Daniel, and go ahead and answer your question. This is a great question, by the way. You asked, in essence, if I could teach you about how to hedge properly. Now, that is a huge topic. And I mean, I could literally create an entire training course on hedging and adjustments and repairs that would take 30 hours to go through. To really get into the details, but I'm going to give you a high-level overview of what that means. And so you were saying, and I'm wondering if you can do anything to rescue or minimize the loss in credit spreads when the price of the underlying asset is approaching my selling strike, which is also my stop-loss trigger price. And the answer is yes. I'm going to show you kind of how I approach that. And then you mentioned down here several times in the Traders Lounge, you help some Tackle members to adjust their positions that went against them. May I ask what your thinking process is when you deal with this kind of adjustment? Do you first identify which component, delta, theta, vega, you need to adjust its effect on the trade before you select to add what kind of options, long call, long put, short put, etc., before or exiting the position? So the answer to all those things is there is a process I go through. And I'm going to show it to you. And I'm going to do it using an Iron Condor, which you mentioned you use credit spreads in the Iron Condor on the right. And I've got a great example for you here on this. So hopefully this makes sense, okay? Now, I happen to have, in this virtual account here, I happen to have a Netflix Iron Condor that is set to expire at maximum gain. And I was looking at putting on a new Iron Condor, both a bull put and a bear call credit spread on this. So, this expires tomorrow, so that trade will be gone. So I'm going to go down here to the positions, and I'm going to actually add the simulated trade. And you mentioned that you sold deltas of 10 on the rut. I'm going to do a delta of 15 on the stock. So I'm going to sell a bull put spread with the selling strike being 15 or less. And I'm going to sell a bear call spread with the short call price being delta of 0.15 or less. So when we do that, let me go ahead and set that up here and just show you that. I've got a little 1-by-1 contract set up where we can sell a 305 by 310 put spread and a 395 by 400 call spread. Now, I went ahead and just set this up in advance, and you can get between the two, you can get a 69-cent credit and a 61-cent credit. And I went out to July 12th. And the reason I went out to July 12th is I like to do condors between 30 to 60 days. And they have earnings out here on the 15th of July. So I'm going to just set up a condor that expires right before earnings. And I could go more conservative. I could go with lower deltas further out of the money. But I feel pretty comfortable and confident with this because I know how to hedge. So I'm putting together this condor, and I went and I set the break-even points at expiration. So I went and set a break-even point here and a break-even point here at expiration. So if the stock stays within these two prices, we'll have a profitable credit spread, bull put and bear call Iron Condor, right? So go look at the chart, and here are those strike prices, way out above resistance, way down below support. And the hedging process starts to happen long before it hits your strike price. And this is kind of an interesting thing to think about with the condors. So the idea behind the condors is that we know the time is going to pass. So I'm going to click on this little calendar over here, and I'm going to move that calendar forward till, say mid-June. We'll go to June 19th, okay? And that's my sister's birthday, so we'll go ahead and go with this. Now, we'll go with this, and we are looking at, the stock price here in the middle, and if that was the case, you'd be sitting on a nice little, profit at that point in time on this little spread. You'd be sitting on a nice profit. But if the stock price started to run, and it started to run down towards support or out towards resistance, this is where you start to feel pain. And this is the area of the chart that I like to call the Bermuda Triangle. This is where trades go to die. Okay, that little Bermuda Triangle there. When traders get into this situation, when they're down and they're losing a bit, and they're still above their strike price, they start hoping and praying that the trade's going to run back up, or they're going to start hoping and praying that the price, moves back the other direction so that it doesn't blow out their credit spread, doesn't blow out their condor. And they set those stop losses out here. Well, think about it this way. If my maximum gain was 130 bucks, right? And you can see that maximum gain if you look at this little window down here. The maximum gain 130 bucks. And if it starts running down and it breaks that strike price, you'll notice here it says like minus 93 bucks or so, minus 90 bucks, by the time it hits that strike price. Well, okay, you're making 130 bucks maximum gain on this, and if you had it go south and it hit that stop, you just wiped out one of your condors. You just took off the returns that you got for the condor that you sold. Now, hedging and adjusting these is a big topic, and I'm going to have you look at this chart, and I'm going to basically say, well, look, if it breaks this first resistance zone and the price is running up, then I have to start to worry because it's going to be moving towards that strike price and entering that Bermuda Triangle I was talking about. Well, the minute it breaks that first resistance zone is when I start to hedge. Okay, so I predetermine my line in the sand where I'm going to start to hedge. Now on the bottom side here, I probably wouldn't panic unless it broke that 200 period moving average. Well, if it breaks that, that's the area where I'm going to start the hedge. Because if I wait, it works a little bit like the old frog in the boiling pot story. And what happens psychologically to traders is as it goes down, this risk graph and it starts to run down, their pain threshold starts to increase and they start to feel pain. And that makes people, they don't like that when they're feeling the pain. And so they sit and they wait and they hope. They're like, oh, maybe it'll go back up. And then, if they're not disciplined and they're not using a stop loss, they can get into big trouble over here where you could lose, quite a bit of money. But if we take action early, we can actually start to steer that risk graph back out and reduce the risk so that as it runs, you're not in pain. You're just kind of like, that's not so bad. Maybe even you're cracking a little smile because you're clever and you know that your hedge is working. So what I did here is I set two price slices at those thresholds. One, if it breaks resistance out here at 370, and the other, if down here it breaks down below 334, that's going to, basically give it, and I actually did it 371, so it actually has to really break that zone, and 334. So a dollar, saying, hey, starts to break out, I'm going to hedge, starts to break down, I'm going to hedge. And I want you to notice here that I'm going to go reset the calendar back to today's date. Whoops. Let me go set that calendar back to today's date. Okay. And if it starts to run in that direction, this is just a 1-by-1 contract trade. I've got this little delta column set up here. Okay. And if it gets out to 371 out here, I've got that little price slice set there. Okay. Now out here's, that break even point, and here's the hedging point, 371. That's the price at which I'm going to hedge. By the time it gets there, the delta is only negative 2.8. You won't be feeling too much pain. You'll be feeling a little bit of pain. Well, okay, I'm going to show you a little trick. I want you to watch this delta. Watch this delta and the gamma. I have to worry about the gamma. And I'm going to take this price slice and I'm going to start sliding it up. And I want you to see how high the delta and the gamma make it climb. It starts to climb out to about -3, -4, keeps on going. It peaks just shy of -5. Now that's assuming no time decay. So if I start to throw in a little time decay and say, okay, well, let's say by middle of June it's running and it starts to hit those prices, you'll notice that the delta is a little bit higher as it's running. So it starts running, that purple line gets a little steeper. You start to see that there, and you can see where, okay, now I need to have, -6 or something like that. So what I do is when that alert goes off and it starts to break above that 371 ballpark, and let me go ahead and set that back to 371 here. My delta at that point in time is about -3 or 4. So I could do something really simple with the stock. You can't really do this on an index, but you can do this with the stock. I could buy, 5 to 10 shares of the stock. So if I go buy, let's call it 5 shares, and I buy it when it hits 371, okay, I'm paying more than the current rate for that. And when I do this, I'm throwing some money at this situation and buying 5 shares of a $371 stock. You'd have to have some capital free. You'd have to have about $1,000 to throw at it in a margin account. So I start to buy the stock 5 shares, and you'll notice an interesting thing happens to that risk graph. It tips it to the upside. Okay, so I can buy stock, and that's called the delta hedge. Basically, this delta is offsetting the negative delta. I'm buying a bullish position to hedge that. Now, that's not overly advanced, just delta hedging with the stock. If it runs down and it breaks support, you do the opposite. Let me go analyze the opposite order here. And let's say it breaks down below 334 down there. Okay, same thing. I short sell 5 shares of the stock, and it tips that sideways. So if it keeps running down, I've got plenty of time to sit and adjust and repair the trade. And basically, you put a trail stop on the stock loss, on the stock position. Okay, that's one technique. Now, I could, again, sit and teach an entire course on this, but let me show you how I think about it. Here I have one of my playbooks. This is one of my mind maps that I use for credit spreads. I use it for all trades. Every trade I do, I have a mind map like this where I have a plan. What do I do if it goes up? What do I do if it goes down? What do I do if it goes sideways? And I have one for a bull put, and I have one for a bear call. I have one for an iron condor, of course. But I'm going to show you just, that bull put side. And the idea is, okay, let's say that the Netflix stock chart starts to break, down. What do I do if it goes down? What do I do if it goes up? What do I do if it goes sideways? Over here is my core conditions and rules. So I follow all these rules, and then this is how I manage the trade. Okay. So, hey, if the trade goes up and I'm winning, these are my choices. I can close the trade. I can hold through expiration. I can offer a nickel to close. I can convert the leg to an iron condor. I can convert it into an iron condor. And this what goes into converting it into a condor if it goes up. If I'm, just did the bull put spread. So I have that basic mind map. Here's what I do if it goes sideways. I close the trade, wait for it time to decay, buy it back for a nickel, that type of thing. Here's where the hedging idea comes in. When it goes down, I've got 1, 2, 3, 4, 5 hedging techniques. I could exit both legs, just stop loss. I could delta hedge, and I got some ideas. Delta hedge, short sell stock at the rate of delta gamma. I could turn it into a ratio if I have multiple legs. That means I can start to break a leg and or add something to it. Or I can roll the option down and out. I have several ways to hedge one strategy. But one of my secret weapons, in addition to those mind maps and learning how to hedge properly, is in the case of like an iron condor, I will do the delta hedge. But one of the things I'll do is, if the stock is running up, and again, you have to imagine that, this price is running up, that bottom leg is winning. So imagine this, if I take off the call spread and just show the put spread, if the stock price is running up, you start seeing profits. And by the time it gets out towards that 371 ballpark, well, gee, I'm pretty much near that maximum gain. So I roll the put side up. So basically, think about it this way. If the stock price starts rising, I'll roll those 2 put strikes up and bring in a bigger credit. What that does is it'll shift the graph up, reduce the risk, whatever credit you get, puts it in the top, and then the top side stays about the same, but it moves your break-even point, just, whatever dollar amount you collected, and then raises the risk graph. So it reduces your risk, gives you more premium, shifts your break-even point up, and barely shifts this break-even point over here. Say, for example, I pulled in another 40-cent credit. Well, the top line goes up 40 cents, the bottom line goes up 40 cents. Bottom line goes up 40 cents, the break-even point shifts 40 cents, and that moves up to the new strike prices up here. So I start rolling. If it's moving up, I start rolling the bottom legs up. If it's moving down, I start rolling the top legs down. And I usually stay in the same month, just trying to narrow it up and bring in some more premium. Then that credit I'm receiving is going towards any delta hedge I need. If I need to buy the stock, if I need to short the stock, whatever money that takes, I need to make sure I have the money free and able to afford the hedge. You can also hedge with things like debit spreads or just long calls, long puts, and you can bring that cost down. Hopefully this video has been helpful for you. Hopefully you got a general idea of it. And what I would encourage you to do is start building your own mind maps. Have that if-then scenario. That's what this is all about. It's all about, hey, what do you do if the trade goes up? Now, stop loss is an effective method, but if you learn how to hedge your credit spreads, you'll do better. If it starts to run down, what do you do if it goes down? And these are big questions. You need to know your trade management by heart, and because I have it mapped out in my mind, I have multiple choices of what kind of hedge I could use. Then it just becomes a matter of, well, I need to delta hedge, for example. I'll start rolling my puts up, for example. And then I will start delta hedging with the stock or the option or maybe a debit spread, or maybe I start ratioing it. And I have multiple choices, and which one I choose really comes down to which one provides the best solution at that time. It's a game day decision. So Coach D with TackleTrading.com, appreciate the great question. Absolutely fantastic question. I really am glad you submitted it. Thanks again for the awesome stock chart in the coaches show. And hopefully this idea catches on and you can have your questions submitted and asked when you participate in our shows. We'll see you guys on the next video.